Whichever way you look at it, the vast majority of companies in the S&P 500 are trading at some severe overvaluations, and that is actually saying something because when we're looking at the performance of these stocks in 2025, many of these are down incredibly double digits, and that is interesting to note because right now we have moved for investor sentiment into greed, and this betrays the fact that investors are buying a lot of shares. They are getting very excited about the market currently. But as a word of caution, we are seeing the S&P on average at a valuation of 28.2, which is far superior than the average at least over the more recent period. And in today's episode, we want to uncover 10 overvalued stocks that are very popular names, and we'll just run through why we believe each one of these are not a buy, at least for the time being. Now, Broadcom isn't a company we're covering today, but we want to highlight how we've been selecting these companies. These are ones, for at least the vast majority of them, where they're trading at valuations well above the 5-year average. So for example, Broadcom at 21.9 is well above the 17.1 average, but on top of that, the yield that you would get with this company at 1.18 is a lot lower than the 5-year average of 2.86%, so you are getting less dividends for every dollar you invest. And the other way that we will be identifying these companies is that when we look at the last 5 years in terms of the average P, with the blue tunnel indicating their fair price, we're going to see many of them, if not every single one, trading at massive disparity between the company's price as well as the upper end of the intrinsic value. Again, another sign of severe undervaluation. So that's just a bit of a background as to how we have arrived at these 10 companies. And we're going to kick off number one in the tobacco space, Ultra Group. Now they are up 39% over the last year. Year to date, they're up 15%. But if you've been a shareholder over the last 10 years, up 14%, you would have massively underperformed the S&P, even if you were to have reinvested those dividends. We can note they're trading at 52-week highs at $60.41, and we only get one buy rating from Seeking Alpha. And as we showed with the example today at Broadcom, their valuation of 11.2 is well above the 9.3, in fact one of the highest they have been valued at over the last 5 years. One severe overvaluation signal. And on the other side, in terms of dividend yield, 6.76%, the lowest or thereabouts in terms of what they've offered against the 5-year average of 8.11, so a double severe undervaluation signal. And that again is also reinforced when we take a look at this model. We can see they are now outside of the upper end of the blue tunnel, not something that we have seen consistently over the last year, something we have only noticed in the last few weeks. So this is what we would say is pointing to all three signs being overvalued. But we also want to cover a few more points before we touch upon our own valuation perspective. In terms of a grading, they get an A-, mainly because in comparison against the sector at 16.2, you are getting a 32% discount, but this is pretty much reinforced no matter which metric you look at. Ultra, for the large part, does trade at a discount to the sector, but in relation to their own 5-year average, we can see they are trading above. Again, that is pretty much consistent right across all the different valuation metrics. Ultra Group is trading at levels above what they have done on a historical point. We'll also reference the growth of each of these companies. Now they get a D-, as we can see here, revenue growth year on year, -1%. Forward looking around the same levels, negative to bear in mind, but against the sector which is trading in positive at low single digit, we can in fact notice that they perhaps do deserve to be trading at a discount. But generally over the last 5 years their revenue growth hasn't been that much at 2% and 1% respectively, and with the EPS over the next 3 to 5 years anticipated to grow at 4%, we can see the sector does come in higher at 6.2 and their own 5-year average also a little bit above at 4.7. Finally, we'll touch upon their earnings, which over the next 4 quarters they do anticipate every single one of them to be growth, and they do have a 75% track record, 3 out of 4 beats against analyst expectations. And for those that want to see into December 2026, their next full accounting period, they're trading on those numbers at a forward valuation of 10.9. And as we said, each one of these will give you our own perspective. Our intrinsic value gets to $58. Now that is the average of the 3 models that you see on screen, and when we do typically do our deeper dives, we run through every single one of these, discussing the inputs and outputs. As we said, we're going to talk about 10 overvalued stocks today, so we're getting straight to it. And given the current price does sit above, you are getting a margin of safety, not 10%, but bear in mind that is what we typically use on this channel to buy stocks if we believe they meet our 3 golden criteria, wide moat, strong financial metrics, and good forward-looking data. So if you believe that for Ultra, you would need to wait to $52. At 5%, it isn't there yet. So we're effectively saying this company is trading near its fair value. For those that did want to see though, at a 10% margin of safety, buy at $52, at 20%, buy at $47, and at 30% around the $41 mark. Now, Wall Street are also in agreement. They don't see any upside over the next year. Their price target is $58. That is from 1 year today, and in fact, that is downside of 3%. As always though, give us your thoughts below about each one of these companies, whether you see them as a buy, hold or sell. And we're not saying these aren't companies you should hold in your portfolio, but at the moment these are definitely not pointing to a buy signal, and at the very best they are looking like a hold. Now before we continue, we just want to let you know we have released our latest free weekly article. We typically drop one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to grab a spreadsheet of severely undervalued stocks for the month of May. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can grab another recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next popular overvalued stock is Costco Wholesale Corporation. Now they're up 34% over the last year, year to date up 10%. Over the last 10 years, unlike what we just saw from Ultra, they have outperformed the S&P up 600%, trading up the upper end of the 52-week range with just one buy rating from Wall Street, and we can see their forward valuation of 54 well above the 5-year rolling of 38, and you could even argue that for this company, 38 itself does look very high, and as highlighted, you're also getting a lower yield at 0.51 against the average of 0.71. In fact, both the yield at the lowest on offer over the last 5 years and the valuation at one of the highest during the same time frame. And probably no surprise again when we do look at this model. Yes, it is good to see the blue tunnel expected price increase over time, but this is really highlighting to us that over the last year at least, this company continues to be trading at a severely overvalued level. And again, no surprises, valuation at an F. The sector itself does sit much lower at 16. You're paying a 247% premium, but you're also paying a premium to what they have been over the last 5 years, as we've just highlighted, in fact 36%, and very consistent no matter what valuation metric you look at, regardless whether you're looking at their historical performance or the sector as a whole. Costco is trading at a very large premium. Now their growth, while they do get an F overall, year on year and forward looking in the 6 to 7% region, which in all honesty is above the sector at the low single digit, but they've been growing their revenue at a slower rate than the last 5 years at 11 and 9% respectively, with EPS expected to grow at 9% over the next 3 to 5, above the sector at 6, but slightly below their own historicals at 10.1, and they do expect growth over the next 4 quarters. However, they did just miss that most recent earnings by 8 cents, giving them a 75% track record, and even if you're looking at this in terms of 2026 numbers, based on that EPS, we can see the forward P will drop to around 50.8, again looking very high. Now our valuation today comes to $707. Given we are just using one model, the DCF, we can show you how we arrived there, but essentially we're using a growth rate of 15%, their average over the last 10 at 67%. As you can see, low, medium and high, 15, 20, 25, and as always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Costco or any others, but effectively we're using a lower rate because we believe that 15% is high in itself, and why we've done this is just to show you at the 20% rate, $990, where it isn't that far off given downside of just 2%. This means if you're adding this company to your portfolio today, already baked into the numbers is 20% growth to the future free cash flow year on year, and that is something that maybe is just a little bit too high even for this company. As we said though, we are using the lower rate of 15%. Coupled with the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 707, and that is 30% upside. If you want upside, then you have to believe at a bare minimum they'll be able to grow at 25%, as that comes to just under $1,400, giving upside of 37. So we're taking the lower rate to the final slide, where as we would like to use a margin of safety, there is in fact none, but this tells us at a 10% based on our price, a buy at 636, at 20 around 565, and at 25 around 530. So this one looks to be trading at a massive premium to the intrinsic price. Wall Street themselves, they disagree, but they do believe there is limited upside. Their price target 1084, translating to 7% over the next year. As always though, do give us your thoughts below. We then move on to the telecom giant AT&T, ticker symbol T. They're up 64% over the last year, year to date up 22%. Over the last 10, down 19%, severely underperforming the S&P. Again, even if you were to reinvest, the yield that at one point was significantly high. And we can note they are trading towards the upper end of the 52-week range. A double buy from Seeking Alpha and Wall Street, and their forward P of 13.3, not only significantly above the average of 8.3, but one of the highest during this period, with a yield of around 4%. On average, over the last 5, it has sat at 6.71, and therefore we do get here this severe overvaluation signal. In fact, if you wanted a reasonable signal for this company, you would have to go all the way to September 2024, but since then disparity has only been getting larger, whilst in fact the expected price from the beginning of the year has started to falter. Valuation grading also at a C+, as they are trading at a bit of a premium to the sector by around 6%, but as we highlighted earlier, 59% premium to their own 5-year average. In terms of growth, they get an F year on year and forward looking, not even at the 1% level, whilst the sector is only marginally higher, to be fair, at 2 and 3%. And over the last 5 years, their revenue has actually been decreasing 2 and 4% respectively. In terms of EPS, negative 3% over the next 3 to 5 years, a bit of a red flag in our opinion, whilst the sector is growing at 10 and their own 5-year, whilst low, still positive at 1%. Only one of the next 4 quarters also anticipated to be growth, but they do have a 100% historical track record, either being in line or a marginal beat. And based on December 26 numbers, they are trading at a forward P of 12.3, with our intrinsic price being just below $27. Again, we have used a growth rate of 2% moving forwards. As we saw, a lot of their numbers aren't looking that great. Revenue is in fact starting to slow down in terms of growth. Earnings per share in fact negative, and as we can see here, $26.56. In terms of the current price, this ultimately means again the company is trading at a premium, but if you wanted to see what would be an acceptable price, at 10% buy at $24, at 15 around $22.5, at 20 $21, and at 25% around the $19-20 mark. Wall Street themselves, again, very limited upside, $30, translating to 7%. We then move on to SAP, which is up 62% over the last year, year to date up 21%. Over the last 10 years, another one that has outperformed the S&P, trading pretty much around their 52 and all-time high. Just one buy rating today from Wall Street, trading at an incredibly high forward P of 41, with their average significantly lower at 22, and the yield on offer pretty much the lowest one they have given to shareholders, 0.62, with the rolling average at 5 years being 1.1. And again, story of the episode today, we're seeing severe overvaluation, but nice to see, unlike the previous company, expected price has been increasing. Yet any point over the last year, if you were to have bought this company, we are looking at a massive overvaluation territory. And we get the F on the grading, with the sector trading a lot lower. You are paying a 110% premium, and again their 5-year average is also a lot lower. You are paying a 60% premium too. So no matter which way you spin it for this company, they are trading at a very high valuation, massive premium already in the numbers, and their growth does come in at a C+, year on year 11%, forward looking at 12, which is above the sector in the mid-single digit, and we can see their own numbers are slightly lower at 6 and 5%. So in all fairness, they are growing their top line at a faster rate than historicals, but in terms of EPS, only around 10%, when the sector does sit higher at 14, and their own 5-year average pretty much coming in line with what is expected from them. But one thing we do quite like is over the next 4 quarters, double digit is expected in every single earnings report, and they have a 75% track record, with 2026 numbers still fairly high forward P being shown at 36.6. Now intrinsic value gets to $224. That is a lot lower than the current price around the $300 mark, and we have gone from the lower growth rate today at 15%. But again, we really wanted to point out here that if you do believe the median rate of 20% is fair, then nearly baked into the numbers is that growth moving forwards. If you wanted some upside, you would need to believe that in the future they can grow at 25% every single year. Using the lower rate, which in all honesty we do believe to be the most reasonable, this gives a fair price of $224. Now Wall Street don't agree, they see 332 over the next year, still very limited upside at 11%, and if we were to consider this, we would want at least a 10% MOS around the $201 mark, for others at 15, 190, and at 20% around 179. But again, give us your thoughts below. We then move on to a company that we like a lot and one that we covered in a recession-proof video. However, it does look to be trading at severely high levels. In fact, over the last year, up 65%. Year to date, up 10%. Over the last 10, another one that's outperformed the S&P, trading near their all-time highs at $105, with again just one buy rating from Wall Street. But we can see their valuation pretty consistent in the episode today at 38.1, the highest on offer over the last 5 years. Their average, in fact, during the period is much lower at 24, and the yield below 1%, when on average this has sat at 1.5. And we can see another company that pretty much for over the last 12 months has been trading at a severely overvalued point. Massive disparity between the two levels here, and their grading coming again to an F, very consistent today. We can see the sector a lot lower, meaning you're paying a 134% premium and a 47% premium to over the last 5 years. Again, very consistent over the vast majority of valuation metrics today for Walmart. And their growth, not that impressive at a C, year on year, in fact 5%, forward looking around the same levels. Sector is a little bit lower at the 1 to 3%, and their own 5-year average not that far off at 5 and 4 respectively, whilst anticipating growth to the EPS 7.7, above, although again marginally, the sector at 6.2, and not that far off their own historicals at 7.4. They also expect 3 of the next 4 quarters to be growth, 100% historical track record, and trading next full accounting period at a forward P that still looks high at 33.8, and our intrinsic value today at $94. Another company that we believe is trading at a premium, means no margin of safety. At 10% though, a buy at $84, at 15 around 80, and at 20 around the $75 mark. For those that want a bit more, 25% margin of safety, $70 buy. And we can see Wall Street, again, very limited upside, even with their buy rating that was on the verge of being a strong buy. 108, upside only 9%. We then move back into the tobacco industry with Philip Morris, and what a run it's been on over the last year, up 78%. Year to date, up 44%. Over the last 10 years, up 100%, marginally underperforming the S&P, pretty much trading at its all-time high at 174. We get a strong buy from Quant and a double buy from Seeking Alpha and Wall Street, trading at the highest valuation it has in quite some time at 22.3, average much lower at 15.5, but also whilst the yield does look attractive at 3.11, on average over the period it has sat significantly above at 5.22, and we get another confirmation here of overvaluation, although towards the back end of the last 12 months you could have bought it in reasonable territory. Right now though, and pretty much at least in 2025, disparity has only been getting bigger and bigger, and they do get a D on the grading. They are trading at quite a large premium to the overall sector at 43%, also 40% above their own 5-year average, and again pretty consistent right across the metrics. Whilst growth does come in at a C+, year on year 7%, forward looking at 8, sector in the low single digits, and we can see they have been growing faster than their 5-year, around the 5% point. EPS expected to grow at 11.4, which is above both sector at 6 and their own historicals at 8.9, and very strong for a tobacco company. They're expecting double-digit growth to the EPS, 100% historical track record, with December 2026 forward PE coming bang on at 21. Now our price gets to $140, again another one trading at severe overvaluations, huge premium. At 10%, a buy at 126, at 20 around 112, at 25 around 105. This is one that Wall Street also believe is very overvalued, even with their buy price a little bit confusing, but they see this at 151 over the next year, downside of 13%. We then move on to the Kroger company, up 32% over the last year, year to date up nearly 20%. Over the last 10, marginal underperformance of the S&P, up nearly 100%, trading near their all-time high. Strong buy from Quant, double buy from Seeking Alpha and Wall Street, and we can see their forward P 15.4 above the 5-year average, and the yield also lower, 1.76 versus 2.14. And as consistent as it can be, we do get another overvaluation signal, one that has only started to show face from the beginning of March, with a grading of B. As we can see, they are trading at a very slight discount to the overall sector, around 5%. 4%, but they're trading 28% higher than their own historical numbers. And for the large part, this is a company that trades at a slight discount to the sector, but actually above what they have done at least over the last 5 years, with growth looking very poor though at a C-, year on year -2%, forward looking only 1, with the sector at the low single digit, and they're also growing their revenue slower than they have done over the last 5 years, around the 3 to 4%, with EPS projected to grow at 6.4%, pretty much in line with the sector, but marginally below what they have done over the last 5, with EPS looking good over the next 4 quarters, 100% expectation of growth, 100% in terms of their performance against analysts, with 2027 forward P coming in around 14.2, and our intrinsic value gets to $69. Now, as we can see, again, another one where the current price is above, so you are getting no margin of safety, but we'll show you for those that want to consider it in the future. 10% a buy at $62, at 20 a buy at $55, at 25% a buy at $51.50. Right now, trading at a premium, Wall Street themselves also seeing downside, $69, -5%. We then move on to IBM, where over the last year up 48%, year to date up 13%, over the last 10 years up only 43%, so underperformed over the longer term. Trading at the upper end of the 52-week range, double buy from Seeking Alpha and Wall Street. Forward P at 22.5, well above the 5-year average at 13.7. The yield significantly below 2.7 versus 4.75. And again, another one that at least over the last year has only been trading at a massive overvaluation, massive disparity, with the grading also in agreement at a D+, although we can in fact see they're only trading at a marginal premium to the sector of 12%, but a massive premium to their own historicals at 50%, and growth doesn't look that great at a C overall, year on year, and in fact forward looking around the 2 to 3%, sector a little bit higher in the mid-single digit, but we can see, and their own 5-year average not that far off. However, EPS over the longer term is one that does let it down, 6.9%, sector a lot higher at 13.8%, and their own 5-year average not that far, 7.2%. In terms of growth though, it is green across the board, which is always great to see, with 2026 numbers coming in at a forward valuation of 21.5, and our intrinsic value gets to $248, pretty much bang on the current price, so we believe right now is its intrinsic value, and we can show you we have gone for a growth rate of 4%, which we do believe to be reasonable for the company, so no margin of safety but no premium, at 10% a buy at 223, at 20% around 198, and at 25 around 186, and as we can see, Wall Street not too dissimilar in their thoughts, $258, 3% upside. We then move on to 3M Company, which is up 44% over the last year, year to date up 7%, over the last 10 years, in fact down 15%, trading towards the upper end of the 52-week range, double buy but from Wall Street and Quant, trading at a forward valuation of 18, above their average at 16.3, with also a yield of 2.1 below the rolling at 3.68. However, they did recently have a dividend cut, which would have skewed the data slightly, but we do get here overvaluation, although just marginal in terms of being outside the blue tunnel, and a D+ on the grading. Now we can in fact see it is trading at a very small premium to the sector at 2.5, but they're trading 18% higher than they have done over the last 5 years, and very consistent. Pretty much we are noticing a premium right across the board. Growth not looking good at all with a C+, negative year on year, forward looking -9%, sector coming in positive mid-single digit, and their own 5-year looking a lot better even with that -1%. In terms of EPS, expected growth around the 8% level, sector is high at 11, but their own 5-year actually quite some way below at 3.6, and we also get another one with green right across the board, always great to see. 2026 valuation coming in at 16.8, and our intrinsic value of $134 is derived using a growth rate of 6%. If you believe 4%, then downside of 16. If you believe growth of 8%, then upside, although very trivial at 11%. And remember, you can always click on the pinned comment below to run your own numbers through, whether it's for 3M or any others, but we're effectively saying no margin of safety, prices aren't dissimilar, at 10% MOS buy at 120, at 20% 108, and at 25 around $100. Wall Street, however, whilst they see upside, very limited, 147, only 6%, but let us know whether you agree, you see this as a buy, hold or sell. We then move on to the final one, DE, Deere & Company, up 19% over the last year, year to date up more than 12%, over the last 10 years, outperforming the S&P up 435%, trading towards the upper end of the 52-week range, just one buy rating from Wall Street, and a forward valuation of 25, well above the 5-year of 16.2, but the yield isn't that too dissimilar from the rolling average. Yet we do in fact here get an overvaluation signal, as well as noting the expected price coming down over the last 12 months. In fact, from September or just before that in 2024, disparity has only gotten larger, overvaluation has only got more prominent, with the grading coming in at a D-, so you are paying a 43% premium to the overall sector, as well as 40% above what they have done historically. Again, that is pretty much reaffirmed right across all valuation metrics. And growth, very, very poor at an F, negative year-on-year 21%, negative forward-looking at 10%. Both sector median, in fact, in the mid-single digit, as well as their own 5-year average, have come in positive, so a little bit disappointing to see, although you can argue it is in a cyclical industry. And EPS expected growth of 7%, lower than both sector at 11 and their own 5-year at 13.5, whilst we get 2 of the next 4 quarters showing growth, 75% historical track record, and 2026 numbers coming in at 21.8, and our intrinsic value at 470 does show this company isn't trading that far off a very marginal premium, but if you wanted this at 10% MOS, a buy at 422, at 23.76, and at 25 around 352. As we said though, trading at a very marginal premium. Wall Street themselves, very limited upside, 487, 2% in fact. But as always, give us your thoughts about these 10 stocks, whether you agree, disagree, see them as a buy, hold or sell. And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.